The S&P 500 is down 11% year to date, and I've been getting asked so many questions. What do you believe is the best stocks to be buying in the stock market pullback? What do you believe is a generational buying opportunity of this pullback? And I've been telling almost everyone that asked me the question, the best kind of stocks to really be buying in this pullback is the Magnificent Seven stocks. And if you know me on YouTube, I'm not really the biggest fan of the Magnificent Seven, and I mostly try to stay outside the index itself, and I just don't like a lot of index exposure in general. But the Magnificent Seven stocks, I mean, we're getting to a point where it's almost impossible to miss. Like, a lot of those stocks are just getting too cheap to ignore. After being loved in 2023 and 2024, they outperformed almost every single stock. And a lot of people felt dumb because they look back at 2022. They're like, oh, if I just bought the big 5 or 7 stocks in the stock market, I would have outperformed anything. And I believe that's how it's likely going to be again in 2026 and 2027. They had an amazing run. This year, they're underperforming. They're down almost 19% this year, as the S&P is down 11%, the Nasdaq is down 16%, so they're underperforming. They will likely outperform again in 2026 and in 2027, and it's, in my opinion, presenting an amazing kind of opportunity. And especially if you look at the quality of those companies, for example, at their profit margins, the Magnificent Seven's profit margins in red, they're around 26%. The S&P 500's profit margin, which is in the blue, is only 13.6%. This is a massive, massive gap in profitability. If you look at the green, this is the growth of the Magnificent Seven. It's around 30% and 25%. This is where the growth is happening. If you look at the blue line, which is the S&P 500 growth, there's really not much growth over there. So most of the contribution is coming from the Magnificent Seven, which normally means that the Magnificent Seven should be trading at a massive premium to the S&P 500. But this is no longer the case. They're even about to trade at a discount to the S&P 500, which hasn't really happened in some time. I believe since 2013 or 2012 or something crazy, they have traded at a discount. And it's about to happen again. If you look at the red line, which is the forward PE ratio of the Magnificent Seven, it's 21.7. Now the blue line, which is the S&P 500's PE ratio, is 20.5. So they're almost trading at the same or at a discount to the S&P 500, despite the massive gap in profit margins and the massive gap in earnings growth. So the Magnificent Seven stocks, in my opinion, they're extremely hated. And I believe those are kind of, you could say, the best stocks to really be buying in the stock market pullback. Now, the main problem is I don't really like a lot of them. Like, there's a lot of the Magnificent Seven I'm not a big fan of. I don't like them. I just don't like those companies. So I believe there's only 2 or 3 that are really the best kind of stocks to buy in the Big Seven. And I'm going to tell you my 2 favorites here in the video. And the first one is a stock that I own, pretty much the only one out of the Big Seven, and this is Amazon. Amazon stock is down almost 18% year to date. Absolutely insane. One of its lowest valuation ever at 17.5 times price to operating cash flow, with an average operating cash flow of 25.5. This is insane for Amazon. You also have, Amazon Web Services. Amazon Web Services is generating $107 billion in last 12 months revenues and operating margins of around 37 to 38%. This is massive profitability for Amazon, and you get exposure to so many different things all within one stock. Even their AI stuff is starting to grow rapidly. And this is a very recent comment from the CEO where he said our AI revenue is growing at triple digits year-on-year percentages and represents a multi-billion-dollar annual revenue run rate. And their AI business is growing rapidly for Amazon. You also have the chips business, which is starting to roll out. They're using a lot of those chips, to Trainium, I believe. That's how you call them. And they've been getting more and more popular, and Amazon is saving some money on them. And they're very powerful, and I'm hearing a lot of positive feedbacks on those chips. And I recently found out that Amazon is even going to launch 3,200 satellites in orbit in the coming years. And I couldn't believe that. I didn't even know that if I own Amazon, I can also get exposure to space. But now I know that, and that's a game changer. And you have so many different bets, like so many different call options, where if they work out, they're going to make so much money from them. It's not even funny. But if they don't work out, they don't lose too much. They have a lot of free cash flow or cash from operations to deploy that stuff and to take on certain risks to invest for growth instead of just buying back stock like Apple and paying a dividend. I would much rather Amazon keep reinvesting in growth, trying to find new growth opportunities, trying to be a leader, and trying to widen its moat and infrastructure and supply chain versus just paying it to me as a dividend or just buying back stock. Although I believe they will ultimately buy back stock. I'm just not sure when. But if I look at the profitability of the company, and mainly, the operating cash flow, it's $143 billion in operating cash flow. It's insane. And this operating cash flow is expected to jump to up to $300 billion by 2029. And I believe this is achievable. Now, the only reason why you don't see any of that stuff is because they're spending $100 billion on CapEx, on all the things I showed you, all the potential growth opportunities and all kind of things. Most of it is gross CapEx, their maintenance CapEx, which means the CapEx that they need to maintain, the freight business and infrastructure and all that stuff isn't $100 billion. It's much, much, much less than that. But most of it is, again, to grow the business, investing in AI, data centers, all these kind of things. For Amazon to keep growing 20-25% in operating cash flow or earnings per share for at least the next 5 to 10 years. And it's very exciting because they can kind of pull it back anytime. And this is when you see the massive jump in free cash flow. But to value Amazon, I'm not going to use free cash flow. I'm using cash from operations because I believe it's a little bit more predictable. And I agree with the growth rate that they have here, which is around 19% CAGR for cash from operations growth. I believe this is highly, highly achievable. So I'm going to take the $300 billion estimate by 2029. And again, I believe it's achievable. For a multiple, price to operating cash flow multiple, I'm going to use the current multiple of 17.5. I'm not going to bet on Amazon going back to the mean of 25, although it's very, very possible. And I think it will ultimately happen. And I wouldn't be surprised if it even ends up being higher for Amazon as the company gets more and more profitable over time. And they do many different things with their cash flow. But I believe 17.5 is a good way to look at it in case they don't get to 300 billion of cash flow. So the way I'm looking at it is I take the 300 billion of potential operating cash flow, and I'm timing it by 17.5 times, which is the price to operating cash flow multiple. I'm getting around $5.2 trillion market cap 5 years from now, which again, people laugh at that, but I believe it's achievable. If I divide it by the current market cap of $2 trillion, this is 162% on the upside on Amazon over the next 5 years, which is almost, I believe, 22% return, annual return on an amazing big company, massive company like Amazon. I mean, this is what I'm saying about those stocks, where you're getting to a point where it's almost impossible to lose money on them. Google and Amazon, all these stocks, I mean, if they keep going down, you pretty much can't miss if you have a 3 or 5 year horizon. And that's what I'm seeing on Amazon right now. Now, yes, they might suffer a little bit from China, but they can, they're working out deals with them, and they can, potentially return their supply chains through Vietnam or other kind of countries. I mean, Amazon has the resources, they have everything. I'm not worried about it, and they can pass most of it to the consumer. So yes, they might have a bad year in 2025, but Amazon Web Services is still going to grow, and a lot of those companies are going to grow and be more profitable. So I couldn't care less about what's happening right now, and I still believe a lot in the long-term potential of Amazon. Now, the second stock that I really like in the Big Seven is Google. Google has been by far, I believe, the weakest stock of the Big Seven. It's down 19.3% year to date. With Google, again, just like Amazon, you get exposure to so many different things, including Google, which is a search engine. And I did discuss the effect of ChatGPT and all that stuff, which I'm not going to talk about again. But you have also YouTube, and you have Google Cloud. Google Cloud has been a beast. They're rapidly growing in terms of operating income and in revenues, but their operating margins right now are around 14%. They were 0% in 2023. They were even losing 47% in 2020. Now they're 14%, and it gets better every single quarter, and they're going to ultimately, in my opinion, reach 25 to 30% in cloud operating margins and this is a game changer for a company like Google. But you also have exposure to Waymo with autonomous vehicles and quantum computing, which I believe Google is one of the leaders in quantum computing. And maybe after this market sell-off is over and people want to get excited about something, they get excited about quantum computing, and maybe Google even trades at a premium then because of their quantum computing investments and their quantum computing exposure. Now, if I look at the company, they've been returning a lot of value to shareholders, mainly through buybacks. They buy back 2 to 3% of the market cap every single year, and they have, I believe, $80 billion in cash. So they have a lot of cash to do buybacks, and I believe they even have a small dividend, if I'm not mistaken. It's like a really small dividend for Google, but they do a lot of buybacks, and I like that very, very much. If I look at the multiple, it's now trading at 17.5 times earnings. I mean, I never really saw Google would get to 17.5 times. I saw the stock would bottom out around 18 times, 18.5, 19, but 17.5, it even went to 16 times. I mean, this is really, really cheap for a company like Google. And I'm not gonna try to make any fancy DCFs or valuation models, because 17.5 times earnings for Google, for all those businesses, and they're still growing earnings per share 11%, 13, 14, 11%. I mean, this is just an amazing company, an amazing valuation. Even if we have a recession and they grow 6% instead of 11%, no big deal. I mean, then the multiple would have ended up being maybe 19 times instead of 17. It's still a deal. So I believe Google is still one of the best Magnificent Seven stocks to buy. My favorite one, again, remains Amazon. This is the one I have in my portfolio. I like it very much, and I like both of them. And I believe the Magnificent Seven stocks in general, I mean, even Nvidia isn't bad. I talked about Meta. I like Meta very much, but the rest, I don't really like them too much at this price, especially Apple and Tesla and a few others. But I like, Amazon. I like Nvidia isn't too bad, and I like Google very much, and even Meta. So this is my opinion on the best stocks to buy in this market. I hope you enjoyed it. It wasn't financial advice, but if you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.